Well, thank you very much, Mark, and good day to everyone out there. Thank you so much for attending this virtual presentation this afternoon, my time at least. It's a tremendously exciting time in the markets. It's really one of the periods in history which will be marked for a very long time. So it's fantastic that we can have this chance to look through the markets. And obviously it's been a strange time in the markets in the world over the last couple of years, and we all miss flying, of course, and hopefully it won't be too long before we're back meeting at conferences such as this in person. But I thought for today we could take a virtual flight around the world and over various countries and various asset classes, and look at a global macro view from 30,000 feet, if you like. So let's before we start with that though, just to give you a bit of background about us. So our work revolves around this man here, Ralph Nelson Elliott, and his discovery of the Elliott wave principle. So back in the 1930s, R.N. Elliott discovered that markets move in a series of patterns which he called waves, and he found that using his empirical research that there was a limited number of patterns in the stock market, and really crucially he found that they repeated at every time frame, and this was the real discovery that he made, because he realized then that markets could be forecasted. The waves turned out to be related by natural mathematics, specifically related to the golden ratio of 1.618. And this slide here just shows the a schematic of how an Elliott wave cycle might look, and we can see how it's related in terms of the numbers, of Fibonacci numbers. Now, you can find out a lot more about this on our website, elliottwave.com, and if you stay to the end of the presentation, I'll be giving you a link where you can get access to free access to the book on the subject by Robert Prechter and A.J. Frost, which is the classic modern book on the Elliott wave principle. So stay tuned to the end of the presentation for that free book. Now, as I said, R.N. Elliott discovered the Elliott wave principle in the 1930s. Before that, we had Charles Dow was writing about the markets in the late 1800s, and he was a financial market journalist, was very interested in market and economic cycles, and his writings became known as the Dow theory. So when Elliott discovered his discoveries about the market in the Elliott wave principle, he really realized that this added a forecasting ability to Dow theory, and gave it a whole lot of extra things as well, and it's unique in its own perspective of the Elliott wave principle. So, but it's this forecasting ability which allows us to be able to look at the markets and anticipate what might happen next, which makes it distinctive from a lot of other forms of technical analysis. Okay, so what about the backdrop of what's happening in the world at the moment? Well, our thesis really revolves around debt and credit, which is the broad sweep of cycles which are in the markets at all times. Now, private sector debt as a percentage of GDP, gross domestic product, if we look at these stats from the OECD back in 2019, we have Luxembourg at the top there at 465% private sector debt to GDP. But we've also got the UK at almost 200%. We've got the US at 220% roughly. And these numbers really haven't changed much over since then. So there's a lot of developed economies in the world at the moment that have a huge amount of private sector debt as a percentage of GDP. And why is that important? Well, if we look at what happened in Japan back in the 1980s, we can see that Japanese private sector debt as a percentage of GDP rose very markedly, similar to what's happened in the Western economies over the last few decades. And then when social mood turned down, which drove the stock market down, we can see that Japanese private sector debt as a percentage of GDP went down. It deflated over the next couple of decades at least, and then some. So this is our thesis, is really that we see a similar situation developing whereby private sector debt will be deflating. And if you look at what happened in Japan as well during that time, as private sector debt was deflating, public sector debt was inflating. And so what's happening now in the markets could be very similar, with public sector debt obviously having a huge increase. Now, specifically, what's happening right now, we look at this chart here, the St. Louis Fed Financial Stress Index. And what this is measuring is the amount of stress in the financial markets based on things like volatility, the level of equity markets, interest rates, the level of corporate bond spreads relative to treasuries. So above the zero line is when the markets are stressed, and you can see here back in these times here. So this would have been the LTCM. A blow up. This was obviously the great financial crisis, so called, and this was the crash of last year. So below the line is when it's the markets are deemed to be relaxed, and we can see during the 1990s the markets were relaxed to this extent, but then as we got through into this century, it became a little bit more unstable. You can see how relaxed, how complacent the markets were back in 06, 07, before the great financial crisis. And we've been in and out of that space over the last decade. But specifically now, look where we are right now. We're right at the extremes of relaxation in the market. So basically, what this is telling us is that market participants see absolutely no worries whatsoever in the markets, and that taking the opposite view of that, when people are expecting no worries, that we might think that it might be time to worry about something. So, but why do people expect no worries? Well, this is the chart that really tells us the story. This is the US N2 money stock, the money supply, the annual change on a percentage basis. And we can see that from the 1960s, it was, contained at, below 15%, 14%. Say. But of course, since World War C, the COVID pandemic, which has been a response by governments and central banks, very much like a conventional war situation, the money printing has gone ballistic. And we can see that obviously the M2 money stock has risen dramatically on an annual change basis. And this is the fuel that's been driving the markets higher. And so this is one of the keys as to what we think is happening. And this is related to debt, to leverage. The more money that's that is in the system, the more liquidity that's in the system, the more it encourages people to take on debt, allied to a positive social mood as well. So this shows the margin debt in the NYSE, and we can see that during the late 1990s, it had grown into the TMT bubble, which reached a peak then. Then there was that crash in the early 2000s. Then we had another huge increase in margin debt for in the real estate and the financials bubble into 2006, 2007. And since 2009, look at the amazing increase in margin debt. And of course, this is the everything bubble. Stocks are up, interest rates are at their lowest, credit spreads, corporate bonds are zooming as well. So this tells us that there's a huge risk in the markets, that there is a fall coming, just like we had in previous occasions. Okay, so we know that debt and leverage conditions are extreme. What do the actual Elliott waves point to? So let's have a look, first of all, at the stock market. So this shows the global stock market, the Vanguard Total World Stock Index ETF. And it's showing that since 2009, we had wave 3 topping out here in 2018, and wave 4 hitting a low in 2020. So that means that the rally since 2020 is wave 5. And so we think this is a terminal wave under the Elliott wave principle. So one of the clues that we really like about this chart is the fact that this pattern here is what we call an expanded flat in terms of the Elliott wave principle. And coming at this point in the cycle, it would tell us that it's very probably a fourth wave. And so that really gives us a lot of confidence that this move from 2020, from the low in 2020, is a fifth wave higher in the global stock market. So when it's complete, and we think it's reaching completion right now, it should result in a very significant fall in this global stock market. The main component of the global stock market, of course, is the US markets. And this is what the long-term chart of the Dow Jones Industrial Average. And what it's showing is where we think we are in the cycles of Elliott waves. From the 1932 low, we think we're just completing a super cycle, wave 5 just now. So from the 1932 low, we have wave 1, which topped in 1937, wave 2 bottoming in 1942, wave 3 topping in 1966, and then a sideways movement for wave 4, which hit a low in 1974. Since the 1970s, all this bull market since the 1970s has been cycle degree, what we call cycle degree wave 5. And we can see another expanded flat situation here in wave 4, in what we call primary degree wave 4, which is circle. So the bottom line for this chart is that the Dow Jones Industrial Average is reaching a significant topping point in terms of the Elliott wave principle. But not only that, if you look at the conventional technical analysis, other parts of technical analysis, some of you might be familiar with outside bars. So this is the first outside year. Last year, was the first outside year since 1982, and that was obviously when the great bull market of the last 4 decades kicked off. But not only that, the outside year was outside the last 3 years. So if you're into Japanese candlesticks as well, you can see this is a potential hanging man of last year's yearly chart in the Dow. So if the markets do fall for the rest of the year, this will be an incredibly bearish signal, not just from an Elliott wave perspective, but also from a Japanese candlestick perspective. So one of the things we're looking at as well from this year's perspective is that 2021 is an amazingly interesting year from a Fibonacci time cycle point of view. It's 2021 is the 1932 low plus 89 years. It's the 1966 cycle degree wave high, cycle degree wave 3 high plus 55 years. It's the 1987 crash plus 34 years. It's the 2000 top plus 21 years. And it's the 2008 crash plus 13 years. So incredibly interesting. And not only that, it's also 233 years from 1788, which is when the Constitution of the USA was ratified. And so it was really the sort of beginning of the USA. So all these numbers are Fibonacci numbers. And so to have such a confluence, a cluster coming in at 2021 tells us that this year could be really one for the history book. So we're expecting the rest of the year to be incredibly exciting. So we can look, we can dig into the equity markets to see other clues for what might be happening. And this shows a chart of the Intercontinental Exchange, the ICE exchange. And of course, ICE owns the New York Stock Exchange, the NYSE. So this pattern here of the Elliott wave from July 2020 shows that we have completed 5 waves higher since then. So this tells us that the markets are now on a downtrend. That this stock is now in a downtrend. So why is that important? Well, exchanges tend to top out in conjunction with general markets as well. And obviously exchanges do well as trading is intensifying, and they do not so well when trading is in a bear market, or markets in a bear market. So the exchange might have topped. Now, if you just look carefully at this chart, you can see that it's a classic second wave here, which had a deep retracement, and this was a classic fourth wave, which had a shallow retracement in a triangle. But stay tuned to the end of the presentation to get the book, and you can learn more about how the waves are constructed. But the message is that the exchange has topped. What about one of the market leaders in Amazon? And so we can see here when Amazon started, it had this amazing rally up in the late 90s, in the mid 1990s to the late 1990s, and then a big massive crash, classic wave 2 situation. Since then, obviously, the market has just been relentless. That Amazon has been relentless in its bull market. But if we look at specifically at the wave counts, we can see that the market is very probably, the Amazon.com is very probably reaching what we think might be a primary degree wave 3 top, which means that it's entering into probably the most significant pause in its uptrend that it's had for a long time, which would tie in with what we think for the general markets as well. Okay, what about flying over to China now? So we can see that China topped out in 2007 in what we think is a cycle degree wave 3, and since then we think it's been tracing a triangle. So if it's a triangle pattern, as we suspect it is, it means that we might have a little bit more to go on the upside in the very short term for China, but really for this market, it is in a long-term bull market, given the triangle pattern, but the triangle was yet to complete, which means that China is due another decline first, again, which might tie in with other markets, coming down. What about Europe? Well, the FTSE in the UK topped out 3 years ago in 2018, so it's already been tracing out the first few waves of its bear market, and it could be poised for what we call a third wave down. And again, if you're interested in more conventional technical analysis, this is a weekly bar chart, and we can see here that this is an outside week of this week just happening now in the FTSE 100. So it could be significant information to tell us that the market could be topping out right now. What about the Stocks Europe 600 index, including the Eurozone index as well? Well, this shows the kind of shorter term chart, a daily bar chart. And what's we're really focused on at the moment is this pattern here, which we think could be a fifth wave top this week. But what's really interesting is that it's gone above its 2020 high then the 2020 high then held as support once, it then held as support twice, which is normally bullish, but just today it's dropped back down below its 2020 high. So it's really interesting, a pivot point at the moment to see what could happen, because if there is what we call a fake out, if the market tries to break out of new highs and then fails to break out of those into those new highs, then it could come down very, very quickly after that. So we're really focused on this right at the moment. Okay, let's skip over to the bond markets. This is the bond universe, the Bloomberg Barclays Global Aggregate Index, the yield of that. So this includes the bonds from treasuries, emerging markets, corporates, just the whole bond universe. And our wave analysis suggests that the low in yield actually was last year, and we're now into a new bull market in yield, so a bear market in price, so a bear market in bond prices. So we're expecting yields in bonds to be moving up from here. In terms of the specific other markets, here's a clue coming from the German Bund. This shows the 10-year yield, and there's no wave count obviously on it, as you can see here, but we do have a wave count which suspects a higher yield moving above zero, back into positive territory from negative territory at the moment. But from a very simple trend line perspective, look at this long term from 2009 downtrend line, and it's a multi-touch downtrend line. Once that's broken, it's very, very significant. And so, this is another clue that yields are headed higher, and that the bond markets are now in a new bear market. Credit spreads as well. If you look at junk bonds, they're very expensive relative to treasuries. This shows the CCC and lower yield spread relative to the US treasuries, and we can see that we're down at the lows, almost at the lowest point since 2007, just before the great financial crisis. Currency markets, well, we're going rather against the crowd at the moment, not because we want to, but just because we're objectively analysing the wave count. Most people think the dollar is going to weaken at the moment. We see a strengthening dollar coming through, and this is the chart of the euro-dollar exchange rate. So if you can flip that round, that is basically the inverse of the dollar index. So a declining euro-dollar means that the dollar is strengthening versus the euro. And so this is the wave cycle that we see, the wave count that we see. We think we're coming into a C wave down, which could be quite powerful over the next few months in euro-dollar, which might take it down towards parity in euro-dollar. But what we call the higher degree of wave count means that this would finish what we call wave Y, and that would mean that after that, the dollar does weaken into quite a significant downtrend in the dollar uptrend in euro-dollar. So bullish US dollar in general first, and then bearish. But the euro probably wouldn't be the weakest currency against the dollar over the next few months. Look at the chart of euro sterling. That suggests that sterling is actually about to depreciate versus the euro. So this chart going up would suggest that the euro is appreciating versus sterling. So sterling weaker is what we think for here. Now, the currency that everyone's interested in at the moment, obviously, is Bitcoin. This is what we see in Bitcoin from its inception. It's in a fifth wave. It's in a what we think is a primary degree fifth wave. So it's ready to top out, at any time. So we're keeping a really close eye on the short-term developments in Bitcoin, because it's in this primary degree fifth wave. And What's interesting as well, from more of a sentiment point of view, we can see that Coinbase has just listed, as we know, the exchange for cryptocurrencies, and the markets have the Bitcoin has slid a little bit since then. But look what happened last time something like this happened, a development in cryptocurrencies. Back in 2017, we had Bitcoin futures launch, and that marked the end of that particular uptrend there. So this might be something similar. We're keeping a very close eye on developments. And lastly, we're going to just take a couple of slides of commodity markets. Now, commodities have been the cheapest in history. This shows the global price of all commodities relative to the Wilshire 5000 stock market, and we can see that it was at its lows, back here this year and last year. Now, Bob Prechter has just published the latest Elliott Wave theorist, and in that he presents a chart similar to this based on the Dow Jones, and shows that really commodities have been in a declining trend relative to stocks for 100 years. So there's a huge amount of potential for commodities on a relative basis. Now, of course, looking at something relative doesn't mean to say that it's going to continue to go up on a nominal basis, but we think there's definitely evidence to suggest that the bear market in commodities has ended. This is the bear market from 2008, and we think this was wave A, this was wave B, wave C of a correction should subdivide into 5 waves, and we can see that there was a 5-wave subdivision here, which ended at the lows of last year. So there's really strong evidence to suggest that the CRB index, commodities in general, have finished their bear market and are now into a new bullish phase. But this movement up here from the low in 2020, there could be a case for saying that this is a 5-wave movement here, and we're coming into a resistance line. So at this particular juncture, I would say there's certainly evidence to suggest that we should be very careful about some commodities, but I would urge everyone to look at the elliottwave.com website for the short-term patterns, because there's lots of opportunities going to be coming in commodities over the next few months and potentially years as well. So in conclusion, then, we've got, from the Elliott Wave perspective, global equity sell-off is imminent. The bond bear market is starting. We've got a final US dollar surge before a longer-term bear trend for the dollar, and the commodity bear market has probably ended. Now, I promised you access to a free book, and if you use this link here, you'll be able to sign up for access to the Elliott Wave Principle, Key to Market Behavior, which was written by Robert Prechter and A.J. Frost back in the late 1970s, and is the book on the Elliott Wave Principle. And so if you'd like to learn more about the Elliott Wave Principle, then please sign up from here. And that is the whiz round our 30,000 feet in the airplane around the world. So thank you very much for listening, and I think I'm on time, Mark. So if we've got time for any questions, I'm happy to take them.
All right, excellent.